morning and welcome everyone to Moneycontrol live stream. You're watching the opening bell and I'm your host Nickey Mirchadani. Well, let's talk about the markets. Indian equities are set for a positive trade to remain range bound. Also, let's talk about Gift Nifty. It's indicating a positive start coming in for Dalal Street, up by as much as 0.25% early in the morning. Let's talk about the US markets. They closed in higher on Thursday, winning back much of the previous day's losses. US economy expanded at a revised rate of 4.9% annual pace in the third quarter. The government data showed. Talk about Asian markets. They've started on a strong footing, tracking US stock rally. Fed rate cuts expectation also led to the surge, of course. FII, they've been the net sellers. That this is something that you really need to be mindful of. They've sold equities to an extent of 1,636 crore and DIIs have bought in to an extent of 1,464 odd crore. Let's also talk about what we have in terms of FNOQs. Well, FIIs have been the net buyers in index futures, net sellers in index options, also the net sellers in stock futures. However, they've been the buyers in Bank Nifty futures and also the Bank Nifty options. That's where some amount of exuberance perhaps is also coming in from. F&O ban. New in the ban is Hindustan Copper. What still remains in the ban is Ashok Leyland, India Cements, Manappuram, SAIL, Balrampur Chini, Delta Corp, RBL Bank. What comes out of the ban is National Aluminium Company and Indus Tower, along with PEL. Talk about the option queues there. Nifty PCR at 1.11 versus 0.66, perhaps indicating that more puts are written as compared to that of calls. So that need to be something that you need to be watchful of. But do bear in mind the fact that we have shown significant amount of recovery from the sell-off that we witnessed on Wednesday. And of course, we are expecting a positive start, but some amount of range-bound trade thereabouts. But let's get going with the strategies, levels, and the top recommendations with Kush Bohra, the founder at kushbohra.com. Morning there and festive greetings out there to you.
Hi, good morning, Nickey. Nobody told me this was a Christmas special.
Okay, it's just the way it is. I mean, it's just a normal day, I would say. But let's also talk about your assessment now on the levels that we are watchful of. Of course, you've seen some amount of recovery which took place. Do you think we are expected to build on from here, or you'll see some amount of resistance coming in for the markets?
Sure thing. So first up, I think the markets are now going to remain a little volatile, largely because of the low volumes. Now, what are the levels we're tracking? For Nifty and for Bank Nifty both, the levels that will apply is the recent high that they made versus the, yesterday's low. So that's perhaps a broad range. So, on the Nifty, if I see about 21,000, 20,950 is where, the floor is right now, especially given the options data for the monthly expiry. That is also suggesting that, that's the floor. On the upside, 21,500, 21,600 zones are resistance. This is corroborated by the options data as well. So from a technical standpoint and a derivative standpoint, this level seems to be these levels rather seem to be the support and the resistance. As I said, slightly broader range, but I think we can expect this kind of a movement in the Nifty, especially given that the volumes are going to remain low. On the Bank Nifty, what does this translate to? So yesterday we saw the Bank Nifty dip just below 47,000, so perhaps that's the floor. And on the upside, close to 48,200. Now, as I said, these are broad ranges, but we expect the volatility to continue for a couple of days. The bias, however, could remain positive.
All right, you expect some amount of thin trade also now to come in, given that we are approaching the festive season and most of the FIIs will start unwinding, perhaps their portfolio there. How do you look at it? I mean, do you expect the trade to remain thin here on, or volumes to rather be lackluster?
Oh, absolutely. That has been the norm and that has been the, observation for the last, few years. And nothing to suggest that it will change. So, we've already seen the Santa rally. In fact, last week, sometime around when I was, on the channel, I said that, the Santa rally is perhaps behind us. Looks like that's the case. If perhaps, Santa's being a little more gracious, then we could head to those, recent high levels. But other than that, I think the volumes will remain thin. And hence the bout of volatility will increase. In fact, that's the reason you see India VIX is very close to 40 now. It's not been close to these levels for many months now. In fact, the last time it was close to these levels, was somewhere close to March, early March, mid-March. So that's explaining that the fact that, even though the indices are moving up, gradually, steadily, the volatility is also picking up. So that will again corroborate the fact that, low volumes and high volatility.
All right, low volumes and high volatility is perhaps that we need to be mindful of. But let's also talk about stocks that you think could be a great idea for the day.
Sure. So I think the mid caps and the small caps already did quite well yesterday after 1 day's pause. I think that's the theme that will continue to play out. So one stock that I have from that space is Deepak Nitrite. Again, the entire chemical space is doing well. It seems like the worst is over. Fundamentally, perhaps even technically as well. So Deepak Nitrite is on our radar. 2335, 2390 are the targets that we're looking at, and 2225 is where I would place my stop loss. Some safety in large cap. Larsen is not a bad idea to hold on to now or even invest. If someone missed on the rally previously, so this is a good buy on dips opportunity. 3495 and 3560 are the near-term targets, and 3375 is where I would place my stop loss.
All right, so a bit of now a mood changes more towards the large caps, of course, after the kind of sell-off that we've seen in the mid cap and the small cap and the recovery thereafter. To bear in mind the fact that the mid cap to GDP ratio and the small cap market capitalization to GDP ratio is near 20-30%, which is almost at the 2007 levels, indicating that there could be some amount of correction perhaps that could come in. So if you want to really place in to have some amount of safer bets, large cap is the place for you, at least on the face of it. Let's address the market open there for you. Well, we're looking at a positive start coming in for Nifty 50, 0.25% of gains coming in for that one, 21,300 mark. So that's the level that we're looking at. It is a good start to the market, and I guess ahead of the festive mood, the festive cheer is already here on the markets. Bank Nifty, let's also look at that. If we can see some amount of participation also coming in from Bank Nifty, well, a bit of subdued trend. So remains to be seen which are the areas of strength which typically are right now supporting the markets. Nevertheless, Bank Nifty, it's a flat start with negative bias. So I think the gains have also been capped on account of the performance that Bank Nifty is showing right now. But let's also look at mid cap and the small cap indices. There is a bit of volatility which has been witnessed within those counters as well. 0.4% of gains clocked in for the mid cap, and small cap acting no difference and perhaps showing a bit of exuberance there. Almost 0.75% of gains clocked in by the small cap index. Let's also talk about the IT and the PSU bank index, along with that of Realty index. Now, to bear in mind the fact that Realty index has been the best performing sectoral index that we have in the entire calendar year thus far. 0.75% of gains clocked in by IT. Next is also PSU Bank that we'd like to see. Of course, PSU Bank also is showing some amount of strength in early deals, and Realty Index is the other one that we like to perhaps make a mention of, because that's the one which outperformed so far in the calendar year, and today's session is acting no different. Let's also look at the top gainers and the top losers of the day, just to see where is the strength really coming in from. Adani Ports, NTPC, Eicher Motors, these are some of the top gainers. ONGC, Hindalco, HCL Technologies, some of the other top gainers along with Tata Steel, UPL and Bajaj Auto. So it's auto and metal, both of these names combined, which have been doing well in trade. Nifty losers, ICICI Bank, M&M and Infosys, essentially Asian Paints, L&T and HDFC Bank. Well, HDFC Bank, thus far, if you've seen the calendar year, single-digit gains followed by double-digit gains. This year has been a single-digit gains. Only hoping that if the historical trend were to be played out, then perhaps this counter could see some amount of traction. Coming back to Kush, what do you make out of this current market opening, and what is your suggestion for few metal names? What do you like from the metal space, along with that of something like HDFC Bank?
Let me start off with the market view. Well, this is fairly in line. perhaps we could continue to trade with a positive bias. So any dip towards the 21 200 2150 kind of levels on the Nifty, and 47 600 47 700 kind of levels on the bank Nifty should be utilized as a buying opportunity, because the put base seems to be getting stronger. So for me, this is a buy on dips kind of a market. Again, because the volumes are thin in the market, the traders should also have their volumes relatively thin. The volatility could be high. Coming to HDFC Bank, well, this has played a great deal of strength, and could continue to take up the momentum going forward as well. We've been bullish on HDFC Bank for a while now and continue to remain so. If you see the stock did not participate in the fall that we saw 2 days ago. Didn't even breach the recent lows. So that's a very encouraging sign. Any fresh entry here would have a target set close to 1720 as the first one and 1750 as the second one. And there's a very clear support zone close to 1650, so that will act as a stop loss. Now, as far as the metal names go, well, some of these are going to remain volatile, and hence a bit of a caution suggested here. Traders with a very strong risk management, or aggressive traders should only enter into the metal space. Tata Steel, after the kind of a strong blip that we saw, has recovered yesterday, continues to remain in the recovery mode today as well. So that's one stock that we've got on our radar. Fresh entry 136 and 140 would be my targets, and on the downside the stop loss comes to 128 kind of levels. One other stock that we have on our radar is JSW Steel. This is for sure on a much stronger footing. So JSW Steel is also something that traders can consider in the metal space. 865 and 885 are the targets, and on the downside the levels that I'm looking at are 830 as a support zone.
All right, so JSW Steel along with HDFC Bank looks interesting at this point of time, but let's also address in the stocks and news that we have just to see whether if there is some amount of momentum which is building up. Zomato is the first one that I'd like to talk about. Its offer for Shiprocket is unlikely to happen. That's what Jefferies report suggests. Brokerage is maintained in the buy call, predicted in a 32% upside, and the analyst feels that the deal is unlikely to happen at this stage. The management has prioritized quick commerce food delivery balance. Overall, it's a Bloomberg report which suggested that Zomato is eyeing in acquisition of Shiprocket for $2 billion. Well, a bit of momentum building in for Zomato irrespective. We're going to get, perspective of Kush in just a bit. Life insurance company is another one that I'd like to talk about. Well, the government has granted one-time exemption to achieve 25% of a minimum public shareholding within 10 years of listing. MPI is essentially minimum public shareholding. Currently, the shareholding for this one stands at 3.50%. The government has held in 96.5% stake in the company. LIC is clearly the stock of the day. Along with that, Allcargo Logistics, where the board has approved in a composite scheme for restructuring of business. International supply chain business is expected to be demerged. The new entity is expected to include an ISC operations. The shareholders will receive 1:1 share in Allcargo ECU. So that also is something that you need to be watching out for. 7.5%. The demerger scheme apparently is flying well with the shareholders in the ratio that has come through. Kush, come in on this one. LIC is what I want to discuss essentially. It's a one-time exemption for that MPS, minimum shareholding, public shareholding. What do you make out of something like a life insurance company? 6.5% uptick there.
Well, after quite a while of underperformance, the stock did actually extremely well. However, now I think that the stock could perhaps pause or consolidate here, because if you see, the volumes are actually thinning down quite a bit. The recent moves that we've seen, in fact, the today move that we've seen is more news driven rather than any volume driven. So I would wait and watch here for a fresh entry. For me, anything above 825 would perhaps trigger a fresh round of momentum. But up until then, what I would do is, if I'm an existing investor, I would keep a trailing stop loss of about 800 and hold on to the position. Fresh entry, as I said, I wouldn't suggest just yet. The volumes are thinning and the consolidation mode seems to be kicking in for the stock.
All right, Kush, we're just going to leave it at that. Thank you so much for taking out the time and having this conversation with us.
Thank you so much.
All right, also do bear in mind the fact that it's a Friday special and there needs to be much of the ground which needs to be covered. And to take the discussion forward, we're being joined by Dipan Mehta, the director at Elixir Equities. Morning there and festive greetings to you.
Good morning and thank you for having me on your show. And Merry Christmas to you and all the best for the new year as well.
All right. Thank you so much for that. Let's start off on this note. What do you make out of this current situation? I mean, what do you make out of the current stance of the market? We saw some amount of correction which came in. Of course, there's been a recovery thereafter. Now that we're approaching further towards the holiday season, you think trades will be lackluster and we might just see range-bound activity playing out at least till fresh triggers come in the month of Jan? How are you looking at it and what's your strategy for the viewers out there?
You said it. I think we just want some peace and tranquility in the last 5-6 days of this year. I think it's been a great year. We have seen a lot of action, a lot of excitement, and actually the market has had a party time. But now I think investors need to party with their friends and relatives and let the market remain a bit sedate, because 2024 is going to be a very exciting year. We'll have, of course, the general elections and a continuation of this rally, hopefully. And also we will see, less risk factors for this market, maybe more liquidity flows. But I must caution that, I know what the next question will be, what should investors do? But I must caution that, anything above 23,000 on the Nifty, I think we're getting into the overheated zone. And one should get cautious and start to build cash reserves, because corrections will come and you should take advantage of that. And you can take advantage only if you have cash in your portfolio.
Okay. With that, what's your strategy? Are you gravitating more towards the large cap names? The famous Ritik scheme apparently, or the theme which is apparently now floating and doing the rounds in the market, that this is going to be one theme which apparently is going to be a place to be in for 2024.
Yeah, I think so. I think that if you want to put fresh money in the market, then the best way to buy is to buy the Nifty stocks, the top 10 companies over there. I think that you will see some amount of outperformance over there. Also, next few months, we expect that the Nifty and the Sensex will outperform the large and mid-cap stocks, and many investors will find that their portfolios are underperforming the Nifty and the Sensex. So strategically and tactically, we feel that large cap stocks have a better chance in the next few weeks and months of the next year. And there would be some cooling off of the mid cap and the large cap and the mid cap and the small cap stocks. Valuations, of course, will be checked again when the earnings season starts. And from the last earnings season to this earnings season, a lot of mid cap and small cap stocks have moved up. So typically when results are announced, if companies do not live up to the expectations, and I would say beyond the expectations of the analysts and the investors, you could expect disappointment and some corrections over there. So I would like to enter the earnings season and the next year on a more cautionary note. But I do expect the Nifty and Sensex to continue to perhaps move up because of a narrow rally in a few stocks.
Okay, Dipan, this one is going to be a little more broad-based question. Of course, it's been a dream run on Dalal Street. And if you talk about the number of main board IPOs that have hit the market in 2023, it's been the highest in over 10 years. And this is not it. We're looking at 60,000 crore of further shares lined up in the next year as well. How do you approach the entire primary market scenario? What do you really like within the space? Something that has been listed but still looks interesting to you, or you're perhaps tracking it a little more in details?
Frankly, I'm avoiding IPO completely. First of all, there's hardly any allocation over there to anybody, any class of investors, whether it's QIPs or whether it's the qualified institutional buyers or high net worth investors or retail investors. And I'm glad SEBI is looking at the entire process of IPO and allotment, because hardly anybody is getting any allocation over there. Secondly, a lot of the stocks which are coming into the market, they are priced at or higher than the peer group companies listed in the secondary market. So I would want to buy a business which is a management and a business which doesn't have a listing track record, as compared to a company management which has a listing track record which is available at or below the IPO price. That's the question that I'm asking. And in a way, the only positive outlook of this whole thing is that we're going to have many more companies to invest in, a lot more choices, and that's fantastic. in my opinion, looking at a company 1 year after its listing makes a lot of sense strategically as well. You have some trading history, you have some listing history. The 2, 3 quarterly numbers also have come through, and one is able to understand the company far better because they can communicate more freely, and some of the statements and information which they cannot share during the IPO does come out over the next 6 to 12 months after they've got listed. So it's best to look at companies 12 months down the line, and all the froth also on the listing would have been over and done with, and you would find them to be available at more reasonable valuations.
I'd also want to understand with the kind of market capitalization to GDP ratio, if that's a measure that you would go by, within the small cap and the mid cap names, they're now at 20 to 30 odd %, similar to the levels that we've seen in 2007. Does that worry you at all, that all the money which has been parked in on all the exuberance that we've seen in the broader markets now perhaps will be dashed with a sharp correction that could come by in 2024?
See, this is very common, and I have seen 4 or 5, maybe more bull markets, and this is exactly what happens. That mid and small cap stocks tend to outperform the large cap stocks by a huge margin, partly because they catch investors fancy, partly because the liquidity is pretty low in these counters, and a little bit of buying also takes these stock prices higher. And then when the economy is doing well, small mid-cap firms tend to do much better than large-cap firms. They tend to gain market share as well. So this is nothing new. And when they correct also in a bear market, the fall is much higher. And even a correction in a bull market, their fall will be much higher. So I would say that it's nothing to be perturbed about. It's part and parcel of investing. If you are buying a small mid-cap stock, and if there's even a 4 or 5% correction in the Nifty, you can expect even 15, 20, 30% correction in your stock. And that's perfectly fine. And if you don't have the stomach for it, then you should not be investing directly into these small mid-cap companies. But the volatility in these companies also offers a great entry position as well, because whenever they correct as fast as they do, and if you have the cash in your portfolio, then certainly you can take advantage of them. There's no denying that small mid-cap companies can grow faster. They offer exposure to certain very micro investment themes, which large cap stocks and larger industries cannot offer. And lastly, the volatility, if you make it play in your favor, then that's fantastic. And a lot of these small mid-cap companies also bring a fantastic value proposition. They are great companies, well managed, superb business models, and good long-term trajectory. Just that you need to buy them at reasonable valuations.
Also, let's talk about Life Insurance Corporation today, because that is one thing which has taken the markets by surprise. 6.5% gain seen by that particular counter as well. The government has granted it a one-time exemption to LIC to achieve the 25% minimum public shareholding within 10 years. Of course, the government has sold in a 3.5% stake in LIC through an IPO, but still it remains at a good 95 odd percent, 96.5% number thereabouts with the government. Remaining, of course, is public shareholding to an extent of 3.5%. How do you navigate things like that? How are you looking at maybe LIC more prospectively with what has happened, and also insurance companies in the years to come? I mean, for 2024 to be specific.
First, a disclosure that we are invested in LIC, and we're very positive on the valuation and the prospects of LIC. It is available at below its value, the embedded value or the adjusted embedded value, and that's going to be even higher because the way stock prices have moved up. LIC is one of the biggest beneficiary of this bull market. Let us not forget that. And it's a pretty well managed portfolio that they have on their books. And that's certainly going to do exceptionally well in times like this. Having said that, the fact that the government is giving an exemption means that there'll be less of a flow of stock from the government, so the counter may remain that much more constricted going ahead or so. And if you compare LIC with some of its other peer group companies in the private sector space, it is available at attractive valuations. And although its growth rates may not be as high as some of the larger private sector insurers, still nonetheless it can have a secular growth rate in the region of 10 to 15% or thereabout. they are focusing on more profitable products. And as and when the share of those products moves up, you will see improvement in financial ratios across the board. So from a valuation perspective, from a safety perspective, and on risk return basis, I think LIC can certainly move up much higher from these levels. But this is not a recommendation. This is just our view. And as I mentioned earlier, the disclosure that we and our clients are investing in LIC.
Mr. Mehta, let's also, be specific and more focused now. One theme that you like the most in the present scenario and the valuations look appealing. Just top 2 stocks within that theme for our viewers.
Again, we are going into the area of disclosures, and please take appropriate note of that. So we are very positive on microfinance companies across the board. I think we have invested in Ujjivan Finance, Credit Access, Spand and Spooty as well. And within the entire NBFC space, this is the fastest growing segment. And they have the highest net interest margins, amongst the best return ratios as well. Valuations are middling as compared to some of the other NBFCs. And with the passage of time, I think these companies have been able to navigate through political turmoil and a lot of other challenges which they face in collection. And even if there were to be a certain event or two where NPAs do spike up, the net interest margin is so huge that it can easily cover such losses. So if you take a 3, 5, 10-year view, we feel these companies can do exceptionally well. And they can be secular growth stories compounding anywhere from 15 to 25% for an extended period of time.
Okay, that's the word. Apparently, we'd also want to chat about IT stocks, along with, of course, the banking counters. But let's first look at the IT space first, because that's been the one which has not really performed so far. Sure, in the last 1 week or 10 odd days, we've seen some amount of performance coming in. Accenture's outlook also isn't really encouraging. But do you think most of the negatives are now priced in and this is the right time to enter into the large cap names, if at all?
Yeah, absolutely. I think that you will see outperformance coming through from the large cap IT stocks. They have underperformed the broader market for an extended period of time, and rightly so. But the important thing is that the US economy is now gradually stabilizing, and the fears of a hard landing are out of the kind of picture at this point of time. So I think that the companies over there in US, maybe even in Europe, will look at the future with far more confidence. And that is what is required to perk up and increase discretionary spends in IT and increase overall spends in technology. And that's why I think Indian IT companies will start to benefit. Give them a quarter or two, and I think they will start to surprise on the upside in terms of what they can deliver. The most heartening fact is that over the last year or so, a lot of the large cap IT companies, including Accenture, have won significant multi-year, multi-million dollar contracts. And it's just that implementation was slowing down and discretionary projects were put on hold. But if the confidence comes back in the economy, then all of these will start to be fast-tracked, and that will instantly get reflected in better performance from the Indian IT companies. And lastly, I would like to say is that this entire generative AI is going to be a big opportunity for software companies, whether it is as big as Y2K or remote infra management, application development, some of the other strong waves of technology which we have seen. Whether it is as big as that, we cannot say that.
Sure. The last, Mr. Mehta, question that I want to ask you is about OMCs and the crude oil. You know, you've seen investors mulling possible impact of Red Sea shipping delays, Angola to leave OPEC. You think all of this will have a bearing on crude oil, and thus you're also looking at OMCs?
See, I think that OMC certainly offer a value proposition, but we all know what the risks are over there. These companies perform only when oil is below $80. The minute oil starts to spike up, then we see underperformance in these companies. And with elections around the corner, you can expect that the government will not permit them to increase petrol and diesel prices. So I think the picture is very clear. If you like a story like this, then by all means one can invest in it. But if the markets were to, go into a frenzy zone, then a lot of investors will focus on low PE stocks, and that's where HP and BP and IFC will come into play. And lastly, some of the expansion plans are going on stream, so you could expect sustainability of earnings. So from a trading perspective, I think these stocks were good, but a 3 to 5 year type of a view on a long-term basis, I'm not that optimistic.
All right, we're just going to leave it at that. And thank you so much for taking on the time and having this conversation with us. All right, let's also not forget the fact that we are approaching IPOs thick and fast. It's just not the end here. We have more issues lined up. In 2023, some 57 Indian companies raised around 49,000 crore through main board, and 27 companies have now already obtained the green light from the market regulator to float their public issues to an extent of 29,000 odd crore. That's that when it comes to the primary market action. Of course, the large street is expected to set in, or let's just say enter the new year with about 60,000 crore odd of share sale lineup, which is put together. So that's not just the end. There is more yet to come, at least when it comes to the primary market. But on this note, we'll just wrap it up here. And thank you and goodbye from the entire team who puts this piece together. Thank you so much for watching. Please do post your feedback for us in the comment section below. Follow us on the link at the bottom of your screen. And for rest of the updates, stay tuned into moneycontrol.com and Moneycontrol app.